Welcome to our CFP exam prep discussion on insurance and risk management. Today, we're diving deep into a crucial concept that often appears on the exam: how to match risk management techniques with different types of risks based on their frequency and severity. Let's break down the main concept. Risk management is about identifying potential losses and deciding how to handle them. The two key factors we consider are frequency, which is how often a loss might occur, and severity, which is how significant the financial impact would be. For high-frequency, high-severity risks, insurance companies generally won't provide coverage because these risks are almost certain to result in losses. The best approach here is risk avoidance. Think about a house built in an area that floods every year with devastating damage. Insurance companies won't touch this, and the smart move is to avoid the situation entirely by relocating. High severity but low frequency risks are where insurance really shines. A perfect example is your home burning down. It's unlikely to happen, but if it does, the financial impact would be catastrophic for most people. This is exactly why homeowners insurance exists and why it's usually required by mortgage lenders. Many students make the mistake of thinking all risks should be insured. However, for low severity risks, insurance often isn't the most cost-effective solution. If you're dealing with frequent but minor risks, like small maintenance issues in a business, risk reduction through better procedures or safety measures might be more appropriate. Here's a practical example that often shows up on the exam. Consider a small business owner facing different risks. A complete loss of inventory due to fire is a low-frequency, high-severity risk that should be insured. Minor shoplifting losses might be high frequency but low severity, making them better candidates for risk reduction through security cameras and better inventory control. A common trap in exam questions involves mixing up retention and insurance for different risk levels. Remember this key point. Risk retention works best for high frequency, low severity risks, where the cost of insurance would exceed the potential losses. Many test takers mistakenly choose insurance for these situations. Let's talk about risk reduction. It's often confused with avoidance on the exam. Risk reduction means you're still taking on the activity, but implementing measures to decrease either the frequency or severity of potential losses. Installing a sprinkler system in a building is risk reduction. Choosing not to build the building at all would be risk avoidance. When you see exam questions about risk management, always analyze both frequency and severity before choosing a solution. The question might describe a scenario and ask for the most appropriate risk management technique. Look for clues about how often the risk occurs and how bad the financial impact would be. The bottom line is that high-frequency, high-severity risks should be avoided if possible. High-severity, low-frequency risks are perfect for insurance. Low-severity risks, regardless of frequency, can often be retained or reduced, depending on the specific situation and cost-benefit analysis. Remember, insurance companies stay profitable by insuring risks that are low frequency but high severity. They generally avoid high-frequency risks because they're almost guaranteed to result in claims and losses. Keep these principles in mind, and you'll be well prepared for the risk management questions on your CFP exam.